tools of monetary policy, sale and purchase of bonds, and communication. The sale and purchase of bond is also called open market operations. This was the main tool that the Fed used to influence the interest rates. They would sell or purchase bonds to impact the quantity of funds available for lending. This is not the main tool anymore, and it is used a lot less than before. What are bonds? Bonds are debt instruments, or IOUs. Federal and local governments, as well as businesses, can issue bonds as a way to raise money. So you can purchase a bond as an individual from the government, and in return, the government will pay you interest, and when the bond reaches its maturity or the end of its life, the government will repay you the original amount that you lent. So the Fed sells bonds to banks, and they sell large amounts, right? Millions and millions of dollars. And so when the Fed is selling bonds to the banks are using their reserve to purchase those bonds, which means that in turn, they have less reserves available to lend to their customers. When that happens, it becomes more expensive to borrow because there are less funds available, and interest rates will tend to rise. If the Fed does the opposite and it purchases bonds from bank, this time the banks are receiving cash from the Fed, and now they have more reserves to lend. Therefore, it becomes less expensive to borrow, and the interest rates tend to fall. Until 2007, these open market operations were the main tool the Fed used to influence interest rates. But this tool became less effective with time, and so the Fed switched strategy, and now the main tool that is being used is the interest on reserves, interest on overnight reverse repurchases, and the discount rate. And this has been a more impactful and more direct strategy than the sale and purchase of bonds.